There's been a lot of talk about the yield curve in the financial media. In order to inform investors, we want to give a brief overview of the yield curve so that you can navigate through the financial markets. The yield curve is considered an economic indicator, primarily a sentiment indicator of investment behavior and perceptions. The yield curve, in its simplest form, is literally just a graph that explains the different yields or returns on various US Treasuries in duration. So on the x-axis, you have the various lengths of duration going from very short term to very long term, and on the y-axis, you have the yield on these respective bonds. However, these yields change on a day-to-day basis, and it's only when they make drastic movements that financial market participants really start to take notice. The graph is typically upward sloping, and this is a reflection of normal business conditions. Long-term bonds are supposed to be higher return bonds because debt issuers have to give a premium to compensate for holding investors' money for longer periods of time. Because of liquidity and opportunity cost, if I buy a 10-year bond, I deserve a higher rate of return versus somebody that buys a 2-year bond because my money is locked up for longer. That means if interest rates rise or other opportunities present themselves in the financial markets, I don't necessarily have the opportunity to act on them. And therefore, for this risk, I demand a higher return. But now the question is, what happens when that yield curve starts to shift? Well, because of the popularity of the yield curve, people don't necessarily look at just the yield curve, but rather the yield spread. The spread is essentially just the 10-year minus the 2-year and looking at the percentage return difference, given that the 10-year and 2-year comparison is the most popular. So here is the 10 to 2-year yield spread over the course of history. As you can see, it has substantial ups and downs. And what you should take note is there's a reason why investors in financial markets are so drawn to it. It has successfully predicted the financial crisis in 2008, as well as the dot-com bubble. And that's why investors are so scared of it today, because as you can see, it's getting close to being zero or even negative in today's world as well. But why does this yield curve move? Well, it's mostly a behavioral response about investors' perceptions about the conditions in financial markets and the economy. In order for the yield curve to flatten, people either have to buy a lot of long-term bonds or sell a lot of short-term bonds, or both. When people are buying a lot of long-term bonds, this raises the price of these bonds, and the price is a reflection of the return you get on these bonds. So when price goes up, yield goes down. And that's kind of what's happening in today's world. Because investors are so aware of the risks in the financial markets, just like throughout history, they tend to push their money into safe havens. One of the safe havens is long-term US Treasuries, which are considered the risk-free rate of return in many cases. Because you're scared of what stocks are going to do as well as other investments, you want to kind of step away from that volatility. One way to do it is to buy a lot of bonds. And that's exactly what's happening in today's world. With trade wars between China and the United States escalating, as well as a number of geopolitical issues around the globe, and adding to this a lot of debt issues, there is risk in financial markets. There's no doubt about it. And that is exactly what you're seeing. But you should take note that just because the yield curve is right sometimes, it doesn't mean it's right all the time. There have been some periods throughout history where the yield curve has begun to flatline and nothing too crazy has happened. So take everything you see with a grain of salt. If you want to learn how to protect yourself during a bear market, we have a video about that, and the link to that is just up right here. But if you're a long-term investor and you invest your money in buying valuable companies with long-term growth prospects, the yield curve shouldn't be that much of a concern for you. We are, after all, bottom-up investors. We look at businesses first, and then we start looking at economic conditions, because the best businesses can stomach economic conditions. So that's a brief overview of the yield curve. We want to thank you guys for listening. Please give us a comment, like, and subscribe. And once again, happy investing.